Welcome, everybody, and welcome back, Greg Sharenow. So excited to have you back. And the first time we sat together, everything we talked about, it was hugely popular, not just because of what you had to say, but just the feedback we had from clients was that it was different. We talked about multiple different asset classes. Well, sorry, different commodities, I should say, still within the kind of commodity sphere. But it was very refreshing to not just talk about oil, is what a lot of people wrote to us about. And I'm really hoping that, Greg, that now that you're back, you give us your perspective, having kind of you leading such a huge portfolio at PIMCO. Give us your objective and give us your views really around what the last 100 days have been with a new president in the US. Markets in really a place where very difficult to articulate where we are and where we are headed. I can't remember the last time we had such high volatility and uncertainty. I think uncertainty for me is the biggest thing that I'm kind of facing on a day-to-day basis, whether it be on the analysis side that we are doing or when I'm talking to clients, because no one knows what to expect. No one knows what's coming next. So for somebody who manages such a huge portfolio, what has it been like the last 100 days? Have you ever experienced something like this before, or has it been fine?
Well, I will say we're also talking today not only the 100-day anniversary of the start of this administration, but also the 4-week anniversary of Liberation Day, which frankly feels more like 4 months to a year than 4 weeks in terms of the volatility we have seen. Now, when I take a step back and I think about being a commodity trader, which I've been now a PM for over 20 years, and before that as an economist for six. So I've seen a variety of market events and spikes in volatility like this. One thing that makes today a little bit unique from, let's say, 2020 with COVID, or 2022 invasion, or 2014 when OPEC changed their production policy, or the global financial crisis, like those were all like events where vol spiked because the economic backdrop and the fundamentals of the markets changed. And it changed from prior expectations and then did so in a meaningful way. And as a result, the system had to adjust. And that volatility, while challenging in some respects, some systematic strategies might work, some might not. Some of your discretionary trades you had on before may or may not work because you weren't positioned for it. But like in many respects, you had the ability to pivot and change because you knew a lot of information, maybe imperfect. Like you didn't know how long the Russian invasion would last for. You didn't know what the sanction policy would be, but like the direction of travel was a little bit more transparent and clear. Right now, over the last 4 weeks, or even 100 days, the policy uncertainty really is tremendous, and the implications for the forward outlook is very meaningful from different potential outcomes from these policy decisions. So it has been more interesting, to say the least. I would say probably more difficult, but also more rich in opportunities when you have like a spike in volatility. So it's kind of like on the one hand, I'm like enjoy it, and the other hand, I'm like kind of wish I had another profession, one that like wouldn't have
Yeah.
a truth bomb at 11 o'clock at
Mhm.
night while I'm asleep. Um, but I
You're
think when you
still in
take
a
a
better
step.
time zone than me, I will say that, when it
Well,
comes
you
to
get
those.
you get 24, your morning you wake up to more till you go to bed, like your news flow in London doesn't end.
Yeah, doesn't
But
end.
I think the stat that really hit me yesterday, I think it really summarizes some of the interesting things in oil, is if you look at like the Dallas Fed survey that came out yesterday on manufacturing. It's at levels that you would typically find in economic distress. Oil prices would be 15 or $20 lower than they are today. But the uncertain, and I think that reflects really that uncertainty. So on the one hand, are the surveys that we're seeing um, presaging something that is like really a problem in the economy, that we're going to see a meaningful slowdown. And like our PIMCO forecasts have come down over the last
Mhm.
4 months since the start of the administration. Are if those surveys are really a forward indicator, then like your outlook for commodities overall and energy in particular really has a different nature to it than if the hard data is better indication and the surveys are really subject to the uncertainty. And as uncertainty resolves, things resolve. How exactly that shakes out will be interesting to see. But that's the
But
opportunities.
yeah, I think that was my follow-up question because, generally speaking, everybody's been revising down the economic outlook. We've just put out our piece. We've just cut our global GDP forecast. We're now at 2.5%, which is arguably, I mean, we would say it's a recessionary number, even calling for a couple of quarters of flat to negative, slightly negative growth for the US. Commodities, which are clearly very leveraged to economic growth, then how does one invest in it? Like, is it an investable asset class still in at times like this?
So the way in which our investors have approached it, I think right now, actually, the last month has been a little bit more paralysis than specific people making a lot of decisions. And I think the best way to say that is like our net flows, our net conversation with clients haven't been truly tilted in one way or the other. But as I mentioned the last time we talked, probably the biggest change still remains that the inflation sting from the last experience was very much supply in nature. A lot of the global investors found themselves short real assets when they needed them in their portfolio, whether it be gold or whether it be broad basket commodities. And have found themselves in a situation where their model of strong emerging market growth, strengthening currencies were not what was realized. So they were less insulated. So even though like our flows haven't really been particularly interesting, our conversations still very much lean into portfolio diversification and how do you construct it. You know, anybody who's trying to trade the cyclical, like, is going to change their minds based on what the outcomes of some of these unfolding on policies. But for those who are like thinking longer term about how do they build a resilient portfolio, I think those conversations are still very salient. You know, I had several this week with clients in Asia who were very much interested in making sure that they have better diversification in their portfolios than they had over the last, you know, couple years, where if they didn't have something like commodities, which ended up being an important driver of returns in 21 and 22 and even into 23.
Yeah, I think we've seen some of that as well. We're definitely talking to folks who I wouldn't put them in the usual bucket of like interested in energy or any of the kind of other commodities that we are covering. And very much coming at it from, we've seen what equity markets have done. And we also want to make sure that we have, you know, we want to understand what's going on in other markets. So I think it definitely resonates with what you're saying. Have you seen a difference in what clients of yours are asking from Asia versus the West? Are you getting more kind of interest in Asia because they're scared of what's going on, that this is an isolationist policy, they kind of have to diversify away from US? Have you picked up on any of that?
You know, it's an interesting question. It's a question I've asked our executive office and, you know, trying to prod. I would say in general, and this is not a commodity specific answer.
Sure.
You know, I think it's, if you look at some, I think Goldman Sachs put out a report recently about, you know, international selling of US assets in the equity market. You know, I mean, that could have been just a short-term response. I think in general, the best way I would think about it is like there's more caution. There's more caution based on the policy. I don't think we've gotten into a period where there's, you know, meaningful divestment. But the questions are, my guess is like incremental dollars are going to have to study. And you've seen like, you know, one of the provincial wealth funds in Canada, for example, 2 weeks ago already stopped like non-essential travel to the US. You know, and now if they have to meet with the poor, like I think that's probably, you know, it's an anecdote. It's not necessarily like a summation of actual data, but I think that kind of like points to probably going to be some challenges with the US being, you know, so clearly and easily as investable as what may have been a year or 5 years or 10 years ago. But I don't think you're at the point where you have to worry about it being a large scale of asset sales. But I think bringing it into commodities and where it matters is I think that's one of the driving features behind gold. And when we talk about Asia and Asian clients, based clients there, you also have Central and South American clients and elsewhere who are thinking about gold as part of their diversifying basket of in their reserves. And I mean, I don't think that conversation is going to go anywhere for a long time. The best way to end that is if gold prices fall for a while. And then, you know, if it goes back to 2000, then people will maybe, you know, in the pro-cyclical nature, you know, be a little less interested. But I think right now, the concerns about the US as investable markets, I think, whether it be treasury or equities, I think is benefiting some.
I mean, you posted something not that long ago about gold. You asked like what was the best performing commodity, and it was gold, and probably will be again this year at this rate. What is the other kind of commodity that's kind of getting interest, or is it mainly just gold right now?
Well, for transparency purposes, we have only broad commodity
Mhm.
investment opportunities outside of carbon. Um, and so I don't know if I don't see it directly in my business. Like the conversations tend to be more around multi-asset portfolio diversification tips,
Mhm.
or even REITs, for example, and how one, assembles a portfolio, then thinking about like, oh, I really want to own oil versus gold. But if you take a step back, probably the most popular question that's asked on a single sector whenever I present is uranium. I think there's a tremendous amount of interest uh, across the spectrum on thinking about how to play uranium long term. That's after gold. That's the number two question, and I've been asked that for 2 years now, regularly. What do you think about uranium? What do you think about uranium? Other than that, oil is always the popular conversation because of the impact to inflation, consumer sentiment, and the pocketbook. So that's where probably the conversation is now. And the other area, commodity, where I would say most of our clients tend to be more constructive, is on copper, because of the secular story of the energy transition and military industrial build out and so forth, and copper being underinvested. But I wouldn't be able to see what clients are doing with that.
Yeah. On energy transition, since you mentioned, have you seen any or sensed any change? Because again, you do talk to the kind of breadth of clients you are talking to is very large, and we've definitely seen the pendulum swing a little bit towards yes, there will be some transition, but not nearly as much on the renewable side. Any of those conversations highlighting that change?
Well, actually, to be honest, I think that's more likely to go in the opposite way from our clients. We are accredited. We have a lot of
Mhm.
credit operations here at PIMCO. And as a result, if there is less interest in investors more broadly and the spreads start widening, the investment opportunity becomes more rich. So, if anything, we see there being a counter-cyclical conversation that ends up coming in. It's like when everything is being crowded in is where we have the greatest
Mm.
problem deploying capital. And when there's less capital coming in, then it actually gets more appealing to a broader number of clients, particularly if they have return thresholds, in the upper single digits, low double digits. You kind of need less crowded in of dollars. So, um, I would say that our international client base, large U.S. pension plans, are really the ones who are interested are largely undeterred, and if anything, are looking for opportunities. Um, so from our standpoint, it's still very popular. Now the question is, does that when you think about long-term natural gas, for example, the ideas are going to change around how green it is or brown it is, whether or not the U.S. is going to be in front of Qatar and other places in terms of investment, how much that means for the balances. Those are going to be conversations that are related to the transition, but are more specific to an individual commodity and its
Yeah, of
balances.
course. Yeah, for sure. So, in terms of like your favorite strategies, because we talked quite a bit last time as well about this, right? We talked about volatility. Where do you stand now in terms of, what should clients really be looking at? Because I've heard from ample different sides how it's untradeable. Every day there's a different headline. So it's a bit like somebody even told me today, you're actually better off going on holiday and making money because you won't lose money, right? Like, I think that's kind of the sentiment. And you are out here saying that, no, actually, you can still make money and you can still get good returns in an environment like this.
I just want to push back on the idea that holidays are cost free. I've never, all my holidays ends up coming to the office and drinking the coffee out of the machine is less
Yeah.
expensive than
Yeah.
many holidays I do. But I mean, I don't think I've ever heard a time where, oh, this is easy. This is
Yeah.
super tradable. Um, when you look back at the year-to-date returns, I don't think it makes a big leap of faith to say a lot of the quantitative driven strategies after having several particularly good years, have struggled this year. Your short vol strategies have obviously struggled. But I think broad basket, a lot of the quantitative strategy, and you can see it in the returns announced already year to date for many of the big quant hedge funds have not been ideal. The trend following momentum has had a problem this year. So if you're asking me like where there's opportunities besides looking at relative value or discretionary typically, I think if you believe that the quantitative strategies are experiencing a drawdown not atypical in history. Like, trend tends to lose money 50% of the time, if not more. Um, at least 50% of the time and more. These are opportunities where I think like if you don't think the world broke or the system broke or the reason why you like them, I think that it's pretty attractive to deploy capital. And historically, when you've had big drawdowns in vol, the vols re-rate, and as a result, you tend to be able to recuperate a lot of those returns over the next 3 and 6 months. So, I mean, I just kind of think of it as like you just got to keep investing through this. Um, Maybe the best way to say is at any time I've guessed that in history, and I've either reduced the strategy in terms of risk allocation, it always preceded the best period.
Right.
So if you take a 30-year approach and you back tested your strategies and you
Mm.
really understand them, I just think you gotta just keep plugging away. Now, and I will say one other benefit of being today than maybe let's say 2022 or 2020. Any strategy at that period of time that thought it was 10 vol became 20 vol overnight.
Yes.
Because
Yes.
a lot of the events are a little more idiosyncratic. I think vols probably from most of these have gone from 10 to 12. And it's a little bit different in that standpoint. I don't feel like you end up being like mechanically forced to reduce them if you have some sort of vol targeting or if you have some risk limits. So I think it's a good time to continue to work. I mean, may not be the best for vacationing. The opposite of this environment means vacationing is that much harder.
Yeah.
Um, but
No, but I think the point you're raising or making is very valid because just I remember 2020, the volumes you were, or even 22, like, or the drawdowns we were hearing of in different people, right? Because people just got stopped out a lot of times as well. Whereas now it is a bit more contained in terms of how this is kind of panning out. But going back to something you said right at the start that, even PIMCO, you've reduced your outlook for global growth. So what is your outlook currently for kind of, global growth, commodity demand, and what are the risks? I think that's kind of worth talking about here as well.
so one of the things that we are trying to get our head around is how much have we front loaded demand this year
Yeah.
in preparation for the tariffs. I mean, anybody who's read the FT or Wall Street Journal
Hmm.
has seen the articles about the freight arriving in the West Coast or the United States, the drop in container ships, the cancellation of ships out of China. Um, and when we start thinking about some commodities like energy, which is very freight and transportation heavy in its composition, and then particularly in the US, when you start adding in what I think is going to be a pretty poor tourism season, I think one has to be pretty cautious on the outlook for refined product demand. And I think that's a pretty big issue. And I think things like air freight, which you can try to keep things moving underneath the deadlines for tariffs, has also been supported. And when you look at just for whatever it's worth, if you look at some like the headlines about the drop in freight, there's base effects were pretty powerful. So the
Yeah, of
percentages look
course.
worse than, whether it be sequential or even year over year. The
Hmm.
first part of last year was a little bit was better than maybe it would have been otherwise, relative to the year before. So some of the headline numbers I think are a little bit exaggerated, but if I start looking at overseas travelers into the United States, which we have through March um, outside of Canada and Mexico, which has some delays in data, like we've took a pretty big step down in March. And maybe the timing of Easter's impact, but like if all of a sudden we're at 2022 level of travel and we're starting to shock some of the trade, and if you look at the oil patch, we start seeing a decline in there, given how diesel intensive it is. I mean, you could easily see yourself in a situation where you're looking at demand growth, you know, quite reasonably sub, million barrels a day.
Yeah.
And if that's the case, and given the fact that a lot of that demand growth is liquids heavy, LPGs, it's not great for the barrel. Um, And if we do see a meaningful manufacturing hit from these trades, I mean that will spill over into other commodities, obviously that are manufacturing intensive. Now, anything I'm going to say on ags is going to be a function of weather,
Yeah.
uh, from Kansas to Iowa City to to Illinois over the course of the next 3 months, 4 months. That'll be the dominant factor, and same weather in Europe and so forth. But in terms of the industrial linked commodities and the travel linked ones, I mean, they're the most susceptible.
And I think to your point earlier as well, it's so difficult because I mean we've seen that our data, and we have a kind of now casting on jet, you can see genuinely the drop off in US demand. You can see it in ticket prices, right? Like, I mean, I come over to the US a lot to know that the drop off is significant, and you've really seen that over the course of April. So I think it is happening. And I mean, like you said, our view as well, we're going to see the hit in H2. We're not seeing it now because it's front loaded. But that's also why like if you look at the crude curve, super backwardated at the front, but you are seeing the contango at the back because people are kind of starting to price that in, which in itself is kind of interesting to watch. But yeah, I mean, look, in the interest of time, we did the same thing last time as well. Kind of your final thoughts, and I mean, I wouldn't say trade recommendations per se, but like, what is it that from an investing point of view, because it's been such an enriching conversation around this. What are, if you were to say highlight criteria, saying, look, these are the things to watch out for, and these are the things that either make a better outlook, like a more optimistic outlook, or even a more bearish outlook. Because to your point, it doesn't matter if it's bullish or bearish. It's about if you've got a medium term or a long term view on things, this is a good time to invest because you just have to keep going with it. Because ultimately, again, these are the times which create the best opportunities. We see that in oil with the kind of price levels or the price levels we are projecting. Shale's going to become a problem, right? It won't be able to grow. Then that creates opportunities potentially for next year. So there's a whole host of things. So like, how would you kind of think about framing it to the investors out there in terms of whether it be things to watch out for or kind of reasons to invest and where, I would say?
So to me, I think probably the most important part to track over the next 3 months is simply going to be, how much did we front load demand? So you can see it in your diesel numbers, you can see it in your jet, kind of as we were just talking about. That's an area I would pay a lot of attention to. When we also, a lot of times in the past, we've had economic shocks. You look at like weather adjusted power demand, weather adjusted gas demand. I just think that's going to be slower as an indicator than it may have been other times. If you look at some of the demand for LNG in the summer in China and Asia Pacific region, as well as coal, I mean, it's been in the doldrums. But typically, the way I think about a lot of commodity demand, particularly in a place like China, and this is relevant for how I think about gold, it's how I model imports of crude oil into China as well, is if you look at like a 6 month exponentially weighted moving average, and you adjust for vol, like when prices are standard deviation rich, you see them backing off price buying. And then when you get back to the moving average, or if you get even underneath it, you start seeing a pickup in activity. It's part of the reason why, we saw a pause in central bank buying of gold in the early part of last year. Prices went up, they came back down, but it was at a higher level than before. And then you saw the behavioral increase. And it's why actually I think you're seeing some pretty strong demand now in crude oil with the sell-off. So what does that mean though to me? I think the concern I have is that you haven't really seen that in LNG yet, but you should. On coal, you haven't really seen it yet. I think you should, but if you don't, I think that's a pretty bad harbinger for economic activity. And granted, there's more renewables and so forth in China. It's not just so simple, but there is a price sensitivity, and we haven't really seen it come back in the region as
Yeah.
prices have come down in TTF and JKM. So that's another area where I'd be watching. I think for investors who are real money, pension funds, endowments, who are thinking about their asset allocations over a long time, I mean, um, the reality is still inflation is going to determine a lot what happens to their nominal bond portfolio. It's going to determine a lot of the equity outlook. We do believe we are, still in a rate cutting cycle, two more cuts this year. We think we will in the US, we've seen it elsewhere, rate cuts. Inflation is how you change that. And if that happens, then you end up getting into a situation where most nominal assets probably end up re-rating again lower. So that would be one reason why a lot of the investors who are taking a longer term outlook is thinking about it.
Yeah, no, exactly. Well, thank you, Greg, so much. This was amazing. And again, I think you've talked about a lot of factors which people are looking at and looking to get guidance on. So this was fantastic. Thank you for joining us again, and hope we'll bring you back soon.
I would love that. Thank you for
Thank
having
you.
me.